Good morning, everyone. Welcome to this morning's webinar. My name is Paul Alker. I'm a chartered financial planner and senior wealth partner with Integritas Wealth Partners here in Jersey. Integritas Wealth Partners are regulated by the Jersey Financial Services Commission for the provision of financial planning advice, investment advice, retirement planning and financial protection, which is the subject of today's presentation, financial protection and estate planning in Jersey. I'm delighted to be joined today and co-hosting today's webinar in conjunction with Karla Summers-Shaw from Viberts, local law firm. Karla has been with Viberts since 2014. I've been doing my homework. I've been looking at their website. She was admitted as an English solicitor in 2017 and recently promoted as personal law associate in the wills and probate team. And Karla will be talking about the estate planning world. My subject, before Karla's presentation, I'll be presenting on financial protection. So in my presentation today, we'll look at the need for financial protection. If someone was to die, suffer a serious illness, or is unable to work due to long-term sickness or disability. We'll look at the key areas of financial protection, whether it be for a business or in your personal life. We'll look at some of the areas to consider where Integritas Wealth Partners are able to provide tailored client solutions with ease, and to take away the worry from you trying to work out for yourself with regards to what covers are relevant, and have a simple process to follow to ensure the best outcomes for our clients' financial well-being. We're also highlighting towards the end of this presentation on some of the resources that we're able to share with clients and any interested parties who may be wanting to learn a little bit more about this particular subject. So let's start with what for many of us will be our largest single asset, and that is their income. So a lot of people will take out insurance for their prized possessions in case they break, they get damaged or destroyed. So for example, they'll have cover on their car, their phones, they'll take out insurance on holidays, even their pets and home contents. But what about the thing that is paid for all of these possessions, their income? If you ask people what the single largest asset will be, a lot of people will say it's their home. But having looked at an average earning, let's say for a 30-year-old, working up until retirement at age 67, according to the Office of National Statistics, a 30-year-old will be earning just over £30,000 a year. If we extrapolate that over 37 years, that is equivalent to £1,125,540, and that's without any pay increases. So a lot of people will think, well, actually, it won't happen to me. It'll be someone else. Well, using LV's risk reality calculator, if we were to take, again, a 30-year-old couple, non-smoking couple, up to the age of their retirement, out of 100 couples, 59 individuals would be out of work for at least 2 months or more. So basically, that means that the bills will still need to be paid. A lot of us don't work for the fun of it. You know, we've got expenses, we've got outgoings, we've got rents, day-to-day bills, dependents that rely on us. So a lot of people will say, well, actually, maybe the states will step in. Well, the average earnings in Jersey, for example, is £780 a week. The statutory sick pay in Jersey, however, is £225 per week. So basically what we're looking at here is a shortfall of around £500 per week that needs to be found from somewhere. And where can it be found from? Well, income protection is an insurance policy that will pay out regular income in the event of a serious illness or disability. The way it works is that you would pay a premium over a month on a monthly basis. And if you're out of work for a period of time, and usually it's a deferred period to coincide with maybe an employer package of sick pay, could be 3 months or 6 months, the income protection will step in and pay the income. The income could be paid for a period of time. So it could be over until financial dependents are grown up, or it could be literally until the day you retire. So now we've looked at the importance of protecting income, let's consider critical illness cover. Let's go back to the couple that we talked about, a 30-year-old couple, non-smoking couple up until the age of retirement. According to LV's risk reality calculator, 27 out of 100 people are going to suffer a serious illness before their retirement. As well as the physical and emotional upheaval of a serious illness, how would one cope financially if you or your partner were to fall ill, even returning to work, even if returning to work is an option after treatment? You'll still need some sort of financial support. Thinking of income, is there something that could be paid off? When we talk about critical illness, we're talking about serious conditions. And the big three are typically a heart attack, cancer, or a stroke, for example. It's very important that if we have a lot of financial commitments, that we have some sort of backup plan. And a little peace of mind can go a long way in this uncertain time. And financial protection can help individuals get the treatment they want and recuperate without having to worry about the bills. A lot of these income protection plans will cover a variety of illness, not just the big three that I mentioned, but it could be a number of conditions, and they can also cover plans in the event the unthinkable may happen to one of your children. So we've considered plans for covering income and also in the event of contracting a serious illness. Now let's think about life cover. Life assurance is really important if you have dependents who rely on you financially. So would a one-off larger pot of money be very helpful in the event of you passing away? It could be to support children until they leave home and are no longer financially dependent. It could be to cover a mortgage. Alternatively, it could be to pay a bill. Now, in Jersey, we don't have inheritance tax, but many people are getting caught by IHT bills if they own residential property in the UK. Alternatively, it could be for a lump sum of money to pay for funeral expenses. If we talk about life cover, we can't really ignore the use of trusts. Obviously, with income protection and critical illness, the cover will be paid to you as the individual. But in the event of your death, life assurance will need to be paid to named beneficiaries. The benefit of having a trust in place is that, well, for IHT planning, it's almost essential in the UK, but for locally, it can avoid certain delays, and it makes sure that the right money can go to the right people at the right time without any lengthy probate delays. Trusts can be complicated, and therefore it's very important that you take advice on whether a trust is applicable and which one would be most applicable to use. We've talked about the three types of cover that we're able to offer our clients, and we're going to just cover a few scenarios where those sort of covers are going to be relevant. So firstly, we're talking about family protection. And this is really where we have financial dependence, and it may not necessarily have to be children. It could be elderly relatives, or if you're a carer looking after someone who needs, it relies on you or your income, financial protection would be very important. So a life assurance or some sort of critical illness cover could come in handy at that stage. For most of us, our largest debt is going to be our mortgage. And it's quite incredible in this day and age to see people having a serious commitment like a mortgage in a family situation and have no cover in place. Obviously, the financial or the emotional upheaval can be terrible in the event of the loss of a loved one, but it would be unthinkable that the family home would be at risk if that was to be that was to occur. We've talked about inheritance tax planning, protecting legacy. We find a number of families may have UK connections and may be subject to inheritance tax issues. And therefore, life assurance can be a good tool to ensure that that legacy is protected and ring-fenced for the future. Income protection, again, we've talked about the need for income protection. And if you are the main breadwinner, having some sort of backup plan with regards to making sure that your income is insured would be a great idea. Obviously, a number of families will want the best for their children, and many people plan for paying for school fees and university fees. Even if they're not planning for them, some people will find that they have that expense in the future. Therefore, having some sort of cover, as well as a payment plan in place, life assurance can be a great tool to ensure that there's an element of insurance just in case the worst was to happen. In Jersey, a lot of families will have large assets, family assets that may be intergenerational, may be passed down from generation to generation. I'm talking about a family heirloom home, perhaps a large property. Farmers, for example, could be their land. And obviously, those families could have a variety of children, and those sort of assets are really hard to be divided up. Therefore, a life assurance policy can be put into place to meet the needs of a family wanting to pass down to named children, where other children may want to have other inheritances. So having a life assurance plan to cover that eventuality would be a good idea. Finally, creating an estate. So we see a lot of retirees worrying about funds that they may be able to leave to their loved ones if they were to pass on. Creating a legacy for their children. Now, the problem is that if we're living in our retirement and we're seeing that that we're worried about spending our kids' inheritance, having a whole of life plan could be a good tool to put in place in the event that you want some assets to be ring-fenced for those children in the future. A whole of life plan actually has a much better return on the premium. So the money that you put into a whole of life plan will produce on typically to normal mortality an 8% return. So it can actually be a reasonable investment for your future heirs. We've talked about the need for personal cover in respect of families. This part of the section is really going to be covering business protection. And I refer to this as our business continuity plan. We all, as businesses, will have continuity plans, or we should have anyway, in the event that premises may get flooded, or even in the event of a pandemic. You know, we've seen this happen, obviously, quite considerably over the last 12 months. But what about in the event of an individual passing away, a key person? There are different types of business protection, and we'll just quickly whistle through them now. So profit protection. Now, this is more commonly known as a key person. This is where there could be a key individual within the business, could be a director or a shareholder or partner, that is either a key earner. So it could be the sales director, for example, bringing in the business, and without that person and the person's contacts, that business could quite easily fall over. So a key person could protect loss of profits or sales. It could also cover the cost of training or finding a replacement to replace that particular individual if the individual was, say, sick for a period of time. Also, it could protect against the potential loss of customers and suppliers if a key member of staff was their main contact. Business succession planning. So we talk to our clients who are running businesses. We ask them, well, have you got your business will in place? And a lot of people scratch their head and think, well, what do you mean a business will? What we're talking about is that a lot of businesses, you know, especially small, medium-sized enterprises, may be co-owned between a number of small partners or shareholders. So business succession planning, also known as shareholder protection, could be a very important tool to have in place to ensure that there's no interruption of the day-to-day running of the business. It also could avoid any disruptions to loan repayments, change of ownership and control, and having to work with new co-owners who may not know much about the business. Shareholder protection can ensure the other owners can keep control and the business can continue running smoothly. So a bit like a mortgage, businesses will have, a lot of businesses will have debt. I think something more than 50% of most businesses have some form of debt, whether it be overdrafts or business loan or even a business or commercial mortgage. And obviously, in the event of a key person or a partner or director passing away, terms of that loan could have to be renegotiated, may have to be refinanced. Maybe the liquid assets of the business may have to be used to pay out individuals. So rather than causing disruption, potential short-term disruption, having a cover in the event of that the key people passing away or even being considerably ill would be a good idea, and to have some sort of business loan protection in place would be advisable. Finally, we can't not talk about our employees' financial well-being. Now, most employers may feel that this is an expensive overhead to have, but it can be a great solution for a lot of businesses who are wanting to increase the appeal of their business to attract new members of staff, potentially to retain talent within the business, and also could provide cost savings for individuals based on group discounts. Typical business employee benefits will include things like private medical insurance, critical illness cover, a death in service package, or some form of sickness income protection cover. It's worthwhile covering the record that of the insurance industry. It doesn't necessarily sometimes have a good past record. This slide really just shows you some of the statistics and are taken from the 2019 payouts as recorded by the Association of British Insurers survey in May 2020. And I would say that in 2020, we'd probably expect these figures to be a lot higher. Well, in 2019, almost 6 billion of claims were paid out. That amounts to around 16 million paid every single day. On average, the typical life assurance claim is around 80,000. Cancer accounts for the largest single reason for a critical illness claim, and along with cancer and musculoskeletal and mental health conditions are the main income protection claims. One of those boxes that stands out, obviously, is that not 100% of claims will be paid out. Typically, the main reason, well, unfortunately, it's non-disclosure. And I think this is a highlight of some of the risks we see where people may actually apply for covers on a do-it-yourself basis, not necessarily think that a condition may be relevant and may miss out on the application stage. And unfortunately, their claim is null and void. This slide really is just an example of the typical protection planning journey that our clients would face if we're trying to help them with setting a plan for them. So after an initial contact, a telephone call, we will arrange an appointment. Before that, we'll send some material, some ideas, some information, a few of our resources, which I'll touch on in a minute. We'll arrange an appointment. Typically, it would have been face-to-face, but more recently, we've been doing a lot of telephone appointments and also video conference. And these first appointments usually take up to about 30 minutes. And that's where we would discuss with our clients, and we try to understand what their needs, what's important to them, ask a few open-ended questions, the what-if questions and how would you feel questions, and really just get a feel for the types of cover that are going to be relevant for them. We're then going to go away and we're going to undertake some research. We're going to compare the market. We're going to look at, depending on the requirements and any particular medical conditions or lifestyle issues, maybe someone who's living abroad, we'd have to find some specialist cover. So we do all that research. We then present that in the form of some illustrations and some quotations with some key facts information. Assuming the individual's happy to proceed, we will then run through an application. Typically, this can be done over the phone, doesn't necessarily have to be face-to-face. Some of the providers that we work with will have an online application. We can send a link through and they can run through the questions in the peace of their own home. All the way through, we're going to be helping in respect of the underwriting process. So for small sums assured and for individuals who've got a very clean medical history, we can actually get cover in place immediately. Alternatively, for larger sums assured, there may be a requirement for medical examination, could be medical attendance report requests, all sorts of tests may be required, a bit more underwriting could be needed. And again, that can take a number of months. I've dealt with a number of large cases for inheritance tax planning, and they've taken quite a few months, but all the way through the process, we would help our clients with that. Once they're happy, again, we would agree a start date for the cover, and if there are trust forms to be completed, we'll help run through that. And as I said, we'll all the way through the process, we're there on hand to make sure to help with any questions, chivvy up any reports that need to be done, and liaise with the underwriters and the client. So this is it, pretty much the end of my presentation. Thank you very much for listening to what can be a very, very dry subject. We don't like to think of the worst happening. What I'd like to do is share some of the resources that we're able to provide our clients at Integritas Wealth Partners. We've got quite a wealth of information and resources for individuals. This is a document, a booklet that we provide a lot of our wealth clients with, which is entitled My Documents, What I Own and Where It's Kept. And really, this is a journal of the professional connections that you have. So who's your lawyer, who is your accountant, who's your financial planner, who's your main contact at the bank, for example, your doctor. What assets do you own? So where is your bank account? What are the bank account details, your pensions, your investments, and also, you know, requests, for example, when it comes to your funeral, for example, what music you might want played at your funeral. So it's a great resource for clients, family, to be able to find should anything happen to their older relatives. They can have access to that information at their fingertip without having to rummage through drawers and cupboards and shoe boxes. We send out a quarterly newsletter for our clients and interested parties, have a number of articles on financial planning, including for financial protection, retirement planning. Usually there's some market commentary. We also have a weekly market commentary and information that we've just negotiated with a partner firm, where we can provide articles through very well-known publications like The Economist, Guardian, Business Insider, Wall Street Journal, and the like. There are brochures. We have a short form brochure and long form brochure for financial protection. We have ones on investment planning. We have ones relating to retirement planning as well. We've designed a number of questions that if people are looking to shop around, what are the sort of questions that you would want to ask a financial planner? So what are their qualifications? What is their experience? What are their fee charges? So there's quite a useful resource. And again, this is all free. And if anyone wants to have access to this, I'm more than happy to send it out after the presentation. We have a website, and on our website, there are different sections relating to different parts of the financial planning process. Here is a small brief snapshot of our protection page, and on there are a few flyers for people to you know, just a thought-provoking with regards to if they want to have a think and get a few ideas as to the sort of financial covers that are available. And finally, our best resource is ourselves. We would always encourage clients to engage with us for a free financial review. This is where we can review existing plans, making sure that they're relevant, making sure they're up to date. Typically, we see lots of legislation changes in retirement planning, but also financial protection plans can become very quickly out of date and not in line with the individual's financial circumstances. That is enough for me. I'm going to hand you over to Karla. Thank you very much for listening. If anyone's got any questions, please leave them to the end of the presentation and ask through the question and answer section. And I'll pass you over to Karla now. Thank you.
Lovely. Thank you, Paul. Give me one moment. I'll just share my screen also. Right, well, thank you very much for that, Paul. So thank you everyone for tuning in today. As the title of my screen says, I'm going to be talking about the importance of making wills, and also just factoring into the talk a couple of key estate planning considerations that usually come part and parcel with will considerations. So just by way of background, I'm an associate at Viberts law firm. I've been doing private client work for about 10 years now. I work in a team of 10 people, and one of the things we have found recently is that with the, I was just saying to Paul, with the COVID-19 pandemic that we've had, that a lot more people have been trying to make wills, or at least planning for the creation of them. Whereas previously we have seen a lot of people have been reluctant to make wills. They don't want to think about their death, even though everybody eventually will die. And this is one of the things that we found. There's either the reluctance to make a will, or that somebody's made a will in the past, and then there's been what I would call a long time period between when they first made them and then when they come back to look at them again and think, oh crikey, they're very out of date. So this talk is really just to sort of get your minds flowing about the sort of points you should be thinking about, and also, do I need to maybe update my will or make one at all? So what I've got here is what I would consider the 10 main reasons for making a will. And certainly the top one, I think, is probably one of the more important ones, because I hear quite a lot of people saying, oh gosh, I don't actually know where all my assets are, or invariably, well, I don't really have anything to leave, so why do I need to make a will? So unless your assets are in joint names with somebody else, usually somebody's going to have something at the end of their life, whether that be a small bank account or a car or some jewelry, personal belongings. And really the idea behind making a will is to just leave a bit of certainty for those left behind over what you wanted to happen with them. And certainly in Jersey, that's quite important, because there isn't a threshold for the amount of assets that you have. And by that, I mean, if you have, say, a couple of £100 in a co-op account, there isn't a threshold to say, oh, well, you're lower than £10,000, so you don't need to make a will, and you don't need your probate in order to obtain those assets. You do. So even for a couple of £100, the co-op is unlikely to shut that account without seeing your will first. So that's really why dealing with your assets is number one. Number two is also important, and intestacy is where you don't have a will. And if you don't have one, then the law dictates what will happen to your assets after you die and who gets what. There's a hierarchy of family members who are due to inherit from your estate, and also who's entitled to deal with your assets on death. Number three goes part and parcel with that, because if you do have an intestacy, very often it may not be what you wanted to happen with your assets. So if you have a will, you can say exactly what you want, and also it doesn't leave behind all the what I would call the trouble and expense that an intestacy does. Because with an intestacy, you need to leave you need to obtain, for example, your beneficiaries doing your family members' death certificates, also their own birth certificates and family trees. And so making a will just cuts all of that out, and you then have a clear line of exactly who you want to inherit from your estate. Obviously, children is another important aspect to consider. You might want to pop into there who you want to act as your children's guardian. And if you have large assets, which you know your children are going to potentially inherit, then maybe you need to consider, is there somebody that I can name as my children's tutor? And a tutor is essentially almost like a trustee. They act in the shoes of that child to look after the assets until they are 18 years or older. And then obviously what I would call is the family element to this. So there's no arguments. You know, if you haven't got a will, the law will say who inherits what, but sometimes there will be squabbles over potentially the sharing of assets, and the will clears all of that up. It can protect your partner and also your children. And those are particularly important things to think about if you are on your second or third relationship, You want to make sure that everybody that you want to inherit is protected in your will, rather than just leaving it to chance. Under Jersey law, we have two distinct types of estate. One of them is movable estate, which I've defined at the top here, and we have immovable estate, which is also defined. So this is really, I think, the important part when it comes to not only making your will and what you want to go into it, but also your estate planning considerations. Because your movable estate, which is your bank accounts and investments, jewelry, cars, are all dealt with under one type of will. And this is where actually what Paul was saying about his My Documents type of file is really important, because a lot of people other than yourself are not going to know what your assets are and who you deal with in terms of your lawyer and your financial advisors. But having everything nice and detailed alongside a will can be extremely helpful for everybody that's left behind when you do pass on. Particularly for movable assets, because Jersey has a little bit of a quirk to the law, and we have forced heirship laws, which I'll explain shortly. So if you haven't left your property in certain percentages, there is the potential for claims. And so seeking estate planning advice about what you have and what you want to do is really quite important. The difference between movable estate and immovable is that your immovable, which is what you can't pick up and walk away with, so your lands and your home, are dealt with separately, and those forced heirship issues don't actually really apply. You can leave your estate to whoever you want. So there's less importance, I suppose, in getting advice about claims on that type of property. But of course, then you might want to be thinking about, right, well, how much is my property? Do my family need to pay stamp duty on my death to actually get the property transferred into their name? And that's all the things that estate planning is quite important to consider when you're thinking about who you might want to leave your property to. Also, I should mention that in Jersey, we make separate wills of movable and immovable estate, because on death, the public registry deals with the immovable property, and the probate registry deals with the movable property. And I think that's a distinction that a lot of people aren't aware of, because obviously if you own a home and your belongings within it, that you would consider that to be your estate. From a legal point of view, they're quite separate. And that's why you'll get different advice depending upon what you're coming to talk about. Now, I did mention the forced heirship considerations, and this is a slide upon it, and we call it legatine. Legatine is a claim that can be made on your movable assets and your movable will. So, for example, if you are married, you're in a marriage, or you have a civil partner and you have children, if you decide to make a will, it's not unusual for people to decide that they will leave everything to their spouse or civil partner, and then failing them to their children. There's nothing wrong with that type of will. It won't invalidate your will in any way by making it. But people do need to be aware that the law says that technically 1/3 should be left to your surviving spouse and civil partner, and another third equally between your children, and another third that you can do what you like with. We call that the freely disposable third. And in most cases, this isn't really a problem, but you might have a child that you haven't spoken to in a while, for example, or you might have a child that for reasons of your own, they might have disabilities or something along those lines, where you might not want them to inherit because it will affect certain benefits, things like that. But if they feel hard done by, then you just need to be aware that there's this potential for a claim that can be made within a year and a day from the date of your death. So sometimes careful consideration needs to be given to what you're actually going to be putting into your will. And on this slide also, I've just explained a little bit about the situation where you only have a surviving spouse or children. And so they, in each scenario, they would receive 2/3, and then you would still have 1/3 that you can leave as you wish. This only affects movable property and not immovable property. And again, that's the importance of maybe seeking legal advice so you understand the different types of asset that you have and what claims can be made. Now, the entitlement to to assets when you don't have a will, this is what I touched upon before about intestacy. If you have no will, you haven't left wishes about how you want your estate to be distributed after your death, and the law kicks in. And so if you have a surviving spouse or civil partner and children, the way that the law says that your estate will be distributed is that your spouse or your civil partner gets the first £30,000 of your movable assets and the household effects. And then anything else after that, your spouse will get half and your children between them will receive half. And some people are happy with that. That isn't a problem. The only downside to the intestacy route is obviously there's no will. So somebody then needs to be picked in order to administer the estate. They'd be called the administrator. And also you then need to work out the family tree and to prove that you are, for example, the only children, that you are the spouse. You need to provide marriage certificates, death certificates for family members, birth certificates, family trees, potentially an affidavit. And this is where it gets a little bit messy. And making a will does actually help to cut a lot of that sort of what I would call time consuming and expense at the end, when obviously people are grieving, they don't necessarily want to have to think about providing those types of documents. And if there is no spouse or civil partner and children, it can become more complicated because you do need to start looking down the family tree and working out who's next in line to inherit. And of course, providing additional documentation to prove that can be a bit time consuming also. So with movable estates, you have the ability to actually name an executor within your will. And the executor is the person who, when you've died, is entitled to have a look at what you have in terms of assets. And then they will start the process by trying to collect those assets in. An executor can be a family member, a trusted friend, anybody who's good with paperwork, or also perhaps a professional. You might want to pick a professional executor if you think there might be squabbles between your family over who you've picked, or potentially you have complex assets and it's more appropriate for a professional to be in that role rather than a family member. And sometimes also family members don't want to take on the role of executor when they've just obviously suffered a loss, and the last thing they want to be thinking about is, you know, what bank accounts did mum have, what do I need to do, and where do I need to send the death certificates. The executor does have an important role, and anybody who is named as one can seek legal advice about how they go about collecting in the assets and paying the debts. And also what they need to think about in terms of distributing those assets in the will. So this comes part and parcel with it, which is what actually happens when you die. This is something that not many people know about. It seems to be a grey area. Everybody knows that death will happen, but not really what happens after the death. So within about 2 weeks of a person's death, a death certificate will be issued. And it's at that point that things can start happening in terms of dealing with the assets, because before that, there's no proof of death. The death certificate will allow the executor to come and collect the will from the law firm who holds it, and they'll then be able to review the will and work out exactly who has been left what. They then need to have an assessment of the assets that are owned by that person and the liabilities. And that's where keeping a careful list of your assets is quite helpful. Some people are very neat, and sometimes when I've gone to people's homes, unfortunately, the paperwork is everywhere and they've kept everything for the last 50 years, and it can be quite time consuming to work out exactly who has what. There's also the uncertainty sometimes I think people have of, right, well, what assets would fall under my will and what wouldn't. So we'll have, for example, joint assets, pensions, life insurances, anything that's overseas. Your executor will have to work out what he can rightly distribute and look after under the will, and what doesn't need to be looked at. So if you've got estate planning advice and some careful list of everything that the executor needs to deal with, that helps a lot more than the executor trying to work it out by him or herself. Calculation of stamp duty. There's a different calculation of stamp duty for movable and immovable assets. We're talking about movable, and for this case, once you've worked out what the assets are and the liabilities, it will enable you to work out exactly what stamp duty is payable on your assets. Applications for probate are then made, and the executor will raise his hand and swear an oath to say that he will administer the estate in accordance with the will and law. And then he will draw in the assets in order to settle the liabilities, and then obviously distribute to the beneficiaries. This is it's quite a long process for the executor. So I wouldn't say it's difficult. There's quite a lot of paperwork involved, and the process can take about a year sometimes to sort out. The only complication can sometimes be if they need to consider probate applications in other jurisdictions. But again, legal advice can always be sought if the executor isn't a professional and isn't sure what needs to happen. And the entitlement to immovable property where there is no will, this is different to what I explained about the movable estate beforehand. Under this, if there is no will, then your civil partner or spouse is actually entitled to a life enjoyment of your matrimonial home. And then what they do is that they share equally with everything else, any other properties, children. The idea behind the life enjoyment is that you shouldn't really leave a spouse homeless, and that's exactly why they're entitled to the life enjoyment. So if that's going to cause a problem in terms of what you want your children to inherit, then obviously that's where legal advice is quite important to work out whether or not you give just an enjoyment of the home, or whether or not you actually want to leave the home to your spouse. In each situation, it will completely depend upon your circumstances and what family members you have. It's slightly different from when you actually do have a will. I've mentioned it down here. It's dower. Dower is a right of a spouse or a civil partner if they're not named in the will as benefiting from the land or the freehold property that the deceased spouse had in their sole name. Then dower can be claimed. Dower is a entitlement to 1/3 of the property itself. You may have heard of a dower wing in a property. It's on that basis that in the olden days, if a husband died, the widow would then be allowed to live in the dower wing of the property. It's the same concept. Nowadays, there isn't really a dower wing. Normally, it's just that you get 1/3 of a home, and that means that the spouse can, if it's rented, get some rent from it, or they can come to some agreement over being bought out of their dower rights. It's an old quirk to the law, which I thought was worth mentioning. Not many people know about it. So this is for a will of immovable estates. What happens when you die? So there isn't an executor in a will of immovable estate. What happens is that the beneficiaries named within it are responsible for registering that will so that title can go into their name. One of the estate planning considerations that a lot of people have to think about is who has been left the property and are they heirs at law? And the heirs at law would be considered to be your spouse and your children. And it's quite important to work that out from the beginning, because if you are heirs at law, then stamp duty isn't applicable. There's just a court administration fee. But if you aren't the heirs at law, then you need to start looking at getting valuations for the property and then calculating what stamp duty is payable. Interestingly, if you have a spouse and children and you have 3 properties, you leave all 3 properties to your heirs at law, your spouse and your children, then stamp duty isn't applicable. But if you then leave 1 property to each person, stamp duty possibly is applicable. So getting some advice about that again is important, because what might seem on the face of it to be a reasonable distribution of the assets, as in one property for each person, could actually cause the beneficiaries to pay quite a lot of money when they're trying to get that property into their name. All wills are registered with the public registry if they're wills of a movable estate, which provide a title. Well, I say all. There are circumstances where some wills aren't, but most of the time they will be. And the public registry has a record to show whether or not properties have been inherited or purchased or sold, and your name will go on there if you've registered your will. And then the beneficiaries will get an act of court, which is essentially a certificate which will prove that they own the property, and that will allow them then to rent it or sell it. So just in summary, today was really a point of just explaining in brief what the difference is between the two types of estate, which is quite important in Jersey, the movable side and the immovable. And when it comes to making wills, there's a lot of steps that I think you need to start thinking about in terms of where are my assets? Are they in my sole name? Are they in joint names? Are they pensions that are dealt with separately under private agreements with the pension provider, or do they need to go into my will? And then obviously I know what my assets are, but does anybody else? So again, I know I've referred to this already, but Paul mentioned my documents book. Actually, that would be really helpful, something along those lines, but just making sure you have a list, knowing yourself exactly what you have. And then obviously deciding, who do I trust to be my executor and who are my beneficiaries? Are there, for example, specific gifts that I want to leave to somebody? Do I have grandchildren who might want my jewelry? And if, unfortunately, if one of my beneficiaries dies, do I want somebody else to inherit in their place? Those are all things that you can put into the wills. And actually, I think from a clarity point of view, it certainly makes better sense than just leaving it to the law under an intestacy, whereby, as I've mentioned, there's unfortunately a lot of more documents that need to be obtained by the people left behind. And invariably, that does cause problems because it takes time. Nobody wants to deal with it when they've had a death. And the will itself actually just cuts all of that out. And that is really what I wanted to talk about. So if there are any questions, I think Paul was going to obviously offer the opportunity for questions to be asked afterwards. So Paul, I'm just going to unshare my screen.
Thank you, Karla. That was very good. Yeah, there are a couple of questions. Let me just get the Q&A box. So mainly for you, Karla, I've got one here. If you are married with no children and then pass away without a will, do all the assets transfer to your spouse and no other person? Question. Or do the intestacy rules kick in and others also benefit?
I was muted, sorry about that. Yes, so if you're married without a will and no children, then the rules of intestacy do kick in. And what will happen is it's usually the spouse then that will inherit, and they will inherit in their entirety. If there isn't a spouse, that's where it becomes more complicated, because you need to start looking at who is the next person in line. And if there are no children, that's when you start looking further down to perhaps your own siblings or their children, and then moving back up the ladder to parents. But the answer to the question is yes, it will be intestacy rules kick in, and it will be the spouse who inherits.
Okay, thank you. And get on the other one. What happens to digital assets? Is the data owned by the individual or the technology company? This is quite obviously very topical.
It is, and the answer is it depends upon what digital asset you have. Very often, if you look into it, you'll find that each digital asset owner has their own rules and regulations about what and what doesn't happen. So I know that, for example, iTunes, you don't actually own the music that you are paying for, and therefore at the end of death, there's no ability to transfer that ownership over to anybody else. I think with Facebook, the account can be left open because you can actually name someone to deal with your account after death. I think Bitcoin's a bit of a grey area. I'm unsure on that because I think, again, they don't allow you necessarily to transfer the title over. And also, I think not only ownership, but you have the problem of not knowing exactly what digital assets or digital accounts you might have. And some people might want to shut those down because the person's no longer alive. And if you haven't specifically mentioned them in a will or written something to the effect that you're giving that person permission, then those accounts may well stay open, indefinitely, because there is no ability for the executor or family members to close them.
Very interesting. Okay, I don't think I've got any more questions at the moment. We've got about 7 minutes left to run, but I think we'll just finish off and thank everyone of those of you who've listened to what can be, I think, is quite a dry subject. Obviously, wills and estates and life insurance, it's not really the sort of thing we want to be thinking about, really. But I think when I first started my career in financial planning, I started off very much looking with my clients, who were sort of quite young people at the time, with this as a bedrock of their financial planning journey. And I see it very much creating the financial wall around your assets and yourself to protect those who rely on you for not just now, but also in the future. So I think it's really fundamental, and making sure that you have a very strong financial plan in place will give you a much greater sense of financial well-being. So I'd just like to thank everyone who's attended. I thank you very much, Karla, for your insights on wills and estates.
Thank you for having me.
Great. And well, I look forward to meeting you in person one day.
Yes.
And everyone out there, just thank you very much for attending, and be safe. And any questions, if you want to direct them to either myself or Karla, by all means, please feel free. I'm happy to follow up with any of the resources. Thank you very much, Karla.
Thank you.